our webinar this month. My name is Sean van den Berg. You can see the topic there is navigate your journey to financial freedom. So freedom is on the minds of many South Africans this month as we celebrate Freedom Day, which is tomorrow, which commemorates South Africa's first democratic election 29 years ago. So one form of freedom that's important to many is financial freedom. For some, this means having enough money to pay for expenses so they can spend their valuable time engaging in activities they enjoy. But also financial freedom is about more than just simply accumulating money or accumulating wealth and being financially stable. So for some people, financial freedom can foster a sense of well-being, a peace of mind, provide greater financial freedom of choice and security, facilitate the fulfillment of goals and generational wealth creation, and help also people position themselves to align their actions with values and take more calculated risks. So there's a lot more to it. To me, the main thing there is just more freedom of choice. So if what's important now also is a question for you, is financial freedom important to you? And if so, do you have a strategy or timelines in place to achieve it? Okay, so I'll be asking some more of those questions as we go along. I see some people still streaming in. Okay, cool. No worries. Okay, as I said, this webinar is being recorded. Any questions you guys have, as I said, we're there to help you. So as I say, my name is Sean van den Berg. I'm an investment specialist here at PSG Wealth. We'll be discussing achieving financial freedom and obviously some investment vehicles or strategies to help you get there. Okay, so my agenda as such, three little points always. Let's move into the next one. What's the difference between financial independence and financial freedom? Why do most people not achieve financial freedom? And what investment vehicles are most suitable to help you achieve financial freedom? Okay, and as I say, we'll have a slot for questions, and then we'll just tie it all up. Okay, so to kick it off, by the way, you can see my previous slide. The idea here with this image was obviously we're navigating the waves, call it the markets, and ideally we were looking for calm seas, but if you're in a sailboat, you need some wind, but also you don't want stormy water as such. So you can also see by this little image here, the idea and the analogy is to keep your eye on the horizon, and obviously on your goals, and your goal should be financial freedom. And you can see by the next slide here, as I say, it's calm waters or smooth sailing, let me put it that way. So the idea here in the whole context of this presentation is to have a plan to help you achieve financial independence. That's number one, and what's more important, to implement that plan. Okay, so let's just give you a quick analogy and the reason why I've chosen those images as such. Okay, so what is financial freedom? So, you know, if you had to go to a party or you go to a place where there's a lot of people in one room, you had to ask them what's the definition of financial freedom, you must probably get a dozen answers, because everybody has different relationships with their money. The term financial freedom rolls off your tongue quite easily, but it's not necessarily as easy to define or to achieve in practice. So to attain financial freedom is a worthwhile goal, and hence this presentation. But also, I believe that for many people, they'll cite financial freedom as being a big personal goal. But I'm also amazed how many people do not have financial freedom as their goal because they've never thought about it. I'm also aware that a lot of people don't think about financial goals in general. So the whole idea is that you know, obviously having the goal of financial freedom is a big goal, because nothing does much to damage one's peace of mind as having a lack of financial freedom. So the whole idea of today's presentation is obviously to create awareness of financial freedom. The opposite would be financial slavery. And I think a lot of people are in that boat. They can't see any hope of getting out of it, but there's always hope. Okay, we'll be discussing ways and means of doing that. So as I say, it means different things to different people. If you look at the big differences here, and this is thanks to ChatGPT, this is the answer I got from that little software. Financial independence is a state. It's a state. I find it quite interesting. It's a state of having sufficient financial resources or passive income streams. So the whole idea here is that sufficient financial resources or passive income streams, and then we're going to talk a lot about passive income streams in today's presentation. The main idea is that you can afford to stop working. You're going to stop working for your money. That's the main idea of financial independence. Financial freedom is also a state where you have complete control over your finances. In other words, I look at it this way as not having any constraints or limitations. You got more choices, as I mentioned just now. So yeah, that's the idea. Financial independence. You're still in a situation you might be working for your money. You want to stop working for your money, and financial freedom. You're in a situation where your money is working for you. As I say, having lots of different income streams, passive income streams. So the idea here also, and this is my personal view on it, I like to see financial independence as independence from the banks, independence or being debt free. So you've got no credit card debt, no personal loans, but also you don't have a home loan or mortgage. And I see financial freedom is going one step further. We have multiple passive income streams that provides time freedom, and that's why I said just now, you can do what you want, when you want to, with who you want to, and how you want to. Okay, so you might want to pursue a passion such as a career in music or sport or art. You want to maybe travel the world more often or travel the world more, so you don't have to worry about your finances. You have enough money to cover your expenses as well as obviously your families and things like it. So that's just quickly in a nutshell the utopian idea, but it is possible. Okay, so why do most people not achieve financial freedom? And I'm going to start with some bad news, hence this slide, but also I want to create awareness, and I want to create hopefully awakening. As I said just now, create an action plan and implement that action plan. So they did a survey or a study a few years ago. Some of you might know this. We have 100 people now aged 25, 40 years later at retirement age of 65. Only one person or 1% will be considered wealthy, and that's obviously financial freedom on their terms. 3% will have adequate savings or investments to secure, to be secure, to have financial security without any financial help. 7% will still have to be working because they must all be working. We'll be discussing that in more detail just now. But 74% of people will be dependent on their pension, their family, friends, or charity to support them. And we have 15% left. Unfortunately, they do not make it to the age of 65. And there's a lot of reasons for that too. They are dead. Could be from ill health, old age, accidents, suicide, you name it. Okay. So as I said, these are stats that some of you might not be aware of. It's quite crazy to think of it that only 4%, around 4% will ever achieve any sort of financial freedom. So if you wear those numbers, what are you going to do about it? So the big question I want to have for you now, where will you be? Okay. So if I may ask, those of you that are parents, and this is something that I feel close to my heart. I wish someone had discussed this with me when I was a bit younger. She discusses this presentation with your children, and it just plant some seeds at a young age. I think it will go a long way to changing these stats. So why do most people not achieve or do not or would not achieve financial freedom? So, I'm not going to explain all of these. They're self-explanatory. The main thing here is, number one, they do not set a goal to achieve financial freedom. Do you know that only 3% of people have written goals? And while 14% might have goals in their head, but it's not written down. But the other 83% tend to drift through life and have little or no direction. So that's quite scary. Now, the way I look at it, as I said just now, we talk about hope, but also I believe that hope is not just it's not an investment strategy. So you can't just hope things are going to get right. You have to do something about it. So the people that do achieve financial freedom, They have that idea of that beginning and end in mind. If you want to achieve financial freedom, well, let's work backwards. So they set a clear and written goal to achieve that. A lot of people do not achieve financial freedom because they spend everything they have, and that's also quite scary. And you might know some people that are in that boat. Some people are living, they spend more than they earn. They're living on credit and things like that. You know, the main thing here, and I want you to remember this: cash flow, or more specifically, what I call surplus cash flow, is like oxygen. So you know, if 81% of people spend everything they earn, and 9% of people are spending more than they earn, it leaves 10% of people that achieve financial freedom. You want to be in that boat. So as I say, cash flow is king. You know, so you want to create ways and means to create extra cash flow, and that's what this presentation is about. They pay themselves last, so they pay off their debt first and everything else, and whatever's left, they might have some savings over. Nah, you want to turn it over your head. Now, I have discussed this in previous webinars. You want to be in a situation where you know, you want to know where your money's going, so have a budget. We'll talk about it in the next slide. You know, income and expenditure, know where your money's going. All you need to know is, you know, if you're paying yourself first, you can live off what's left instead of the other way around. So some of you might have heard of this before, and I have discussed this also in other previous webinars, using the 20, 30, 50 rule with regards to your income. So 20%, allocate 20% of your monthly income or your salary to long-term savings and investments. In other words, pay yourself first. 30% to lifestyle choices. You worked hard for your money, so you might want to enjoy some of your money. And then the other 50%, that's what you use for your necessities, your bond and everything else. Okay. When it comes to debt, we all know about the bad debt. You know, and the way I look at it also, I read a book years ago that also changed my ideas. Robert Kiyosaki's book called Rich Dad, Poor Dad. A lot of people buy liabilities instead of assets. And Robert Kiyosaki's definition of an asset is something that puts money in your pocket, whereas a liability takes money out of your pocket. So a lot of people buy toys and things like that, and they have this great lifestyle. The main idea here is to avoid unnecessary lifestyle spending and racking up credit card debt and things like that. So the idea is to practice delayed gratification. So later down the line, when you have the passive income streams, yes, this is where we start looking at buying the toys and things like that, if you still want those toys. Okay, and then you know, talking about home loan repayments and you know, the minimum payment and things like that. I have also discussed that in last month's webinar. I think the main thing here I want to highlight for you, the people that achieve financial freedom live humbly. You know, you want to buy a house that's suitable for your needs. You don't want to keep up with the Joneses. You know, so you don't need a trophy home right in the beginning. Again, remember, I want to highlight that idea. If you're paying off your bond as fast as you can, yes, the idea is to use that surplus income, surplus to pay off, to invest into other investments. And also, obviously, if you're paying your bond off faster, you can save up a lot more in interest and things like that. So that's what's important. So one thing I've come across when I was doing the research for this presentation, a budget-friendly way to pay off your bond faster is to pay what they call 1/12 or extra payment every month. In other words, if you're paying you're paying 9,750 Rand each month on a 9,000 Rand mortgage payment, you have paid the equivalent of one extra payment a year. So what it is if your bond is 9,000 Rand right now, multiply that by 12, you get 108,000, and you add an extra payment, which is 9,000, you'll get 117,000. Divide that by 12, and that's how you get your 9,750 Rand. So that extra 750 Rand a month will help you pay off a equivalent of one bond payment a year. That's one way of looking at it. Another way of reducing your bond term is obviously to round up. So if you're paying if your bond is 7,430 Rand, round it up to 8,000, round up to the closest 1,000, you know, round up to 9,000 instead of paying 8,600. Just different ways. Yes, I know it's all of us have debit orders and things like that, but you can actually make additional payments into your bond, especially with online banking. So yeah, just some ideas there. Just different ways of just saving interest down the line. So as I say, we have touched all these things before. As I say, they're also self-explanatory. And then also, yeah, we got people that they put off saving until they can afford it, which means never. The whole idea here is no matter what position you're in, you're currently in, just get started. So those of you that just started working now, the young guys, save as what you can. As I say, pay yourself first. 10 to 20% right up front. The whole idea is to build good financial habits with small amounts of money. It's like building a muscle. When you go to gym and getting fit, you'll be slowly also becoming financially fit. Okay, so people make bad and impulsive investment decisions. People spend more time. Some of you heard this before. People spend more time planning their holiday than they do the investment decisions. So the whole idea here is that you don't just stand around to buy investments on tips. Do your homework. Go seek advice and guidance. Go get yourself a financial advisor. I know there's some financial advisors on this webinar today. The whole idea is to make informed investment decisions. Take calculated risks. But also, I find that a lot of people that are financially independent also do not rush and make a fast decision. Okay, when they get all the information, they make a quick decision and they change their mind slowly. So yeah, interesting. Also, a lot of people become complacent and accept the current reality. I'm amazed how many people have given up on life. They're waiting to die. I know I'm being a bit harsh here, but the people that working towards achieving financial freedom, I find these people do not settle. They stay committed. They keep learning and they keep growing despite the setbacks they might be having. Okay, and then there we go. They don't have the required self-discipline to stick to it, and I think this is the main reason why people do not achieve their goals in life. You need to be disciplined and you need to be consistent. Those are the two things that go hand in hand. So that's why I like retirement annuity for a lot of people as a form of disciplined savings, because you can't have access to your funds until the age of 55. That forces you to stick to your plan, retirement savings. Okay. And then the last one there, they don't figure it all by themselves. The idea is to build up a team. Have a financial advisor, have the accountant, have the bond or the mortgage originator with you as a team. Have a lawyer, and that's where I think PSG Wealth, the offices can help you a lot with that. And that's where I think a lot of people are on the right track in that regard. Okay, so the whole idea is to build a collaborative team. We work together towards a common goal. Okay. And then obviously, the whole idea, as I said just now, it's all about cash flow and time. We have spoken about this also in previous webinars, the magic of compounding, the magic of how time works in your favor. And some of us might have heard of it, some of us not. It comes to mind when I talk about the rule of 72. So that's a shortcut rule of thumb to help you estimate the number of years required to double your money or your investment at a given rate of return. That's one way of looking at it. So there's two ways of looking at it. So number one, the years to double your money. So 72 divided by the expected rate of return. So let's say, example, we're getting 10% growth on our investment a year. Take 72 divided by 10%. It's going to take us 7.2 years to double our investment. Okay, so that's one way of looking at it, years to double. Another way of looking at it, the rule of 72 is taking the expected rate of return to calculate the expected rate of return. So take 72, and then say your goal is to double your money in 5 years. What kind of investment do I need? What kind of investment growth do I need to achieve that? So 72 divided by the years to double. So let's say 72 divided by 5. I need investment to give me 14.4% growth. So that's what you're going to be chasing. Okay, so just remember those two ways of looking at it. So let's talk about the fastest way to achieve financial freedom. I'm going to go through this very quickly. Very simple. Create a budget, reduce expenses, all of the stuff we have spoken before. I'm not going to go into too much detail here. Save and invest consistently. So remember I said you just now, it's discipline and consistency. Okay, so the earlier you start, the better. So again, that's what I'm saying with those of you that are the parents, get your children to look at this. Avoid debt, bad debt, credit cards and personal loans. You don't need that. Okay. And if you do have those kind of debts, pay them more fastly. We have spoken about this also. I think it was last month's webinar. I said if your credit card charging you 24%, you pay that credit card off, you're saving yourself 24%. Very important, have an emergency fund. We have spoken about it before. And then if you just start out work, you're still young, you still got energy, have various income sources. And that's what I talk about active. So you can start a side hustle, start a second job, whatever the case might be. As many opportunities to, that's your biggest asset when you're young, is yourself. So invest in yourself. The goal here is to develop multiple streams of income. And yeah, we're talking about having a share portfolio is going to give you dividend income, have a property portfolio of rental income. You can have, as I say, side hustles, different ways of doing it too. Ultimately, the share market is one of the better places to invest because historically gives you the highest returns. But I want to highlight for you, education is very important. Okay. And then the last slide there is obviously educate yourself. Go to seminars, buy the books. There's so much stuff available on the internet for free. Okay, one of my favorite websites is called investopedia.com. There's a wealth of information there. Udemy, a lot of courses there you can do, etc. Okay, LinkedIn. I'm a member of LinkedIn, and you can go do courses there too. There's a lot available. Okay, but I want to spend some time on this. How do you calculate your number? And this is the biggest problem, I think, for a lot of people that don't know how much is enough and therefore don't aim high enough. You know, they have this rude awakening when they come closer to retirement age and find out, geez, I've got a shortfall, I don't have enough to retire. Okay, so it's usually disappointing. You think you're on track, you're retired at age of 65, and as I say, you realize you don't have nearly enough. So we spoke about the rule of 72. Yeah, we're going to talk about the 4% rule. Some of you might have heard us before. So, you know, if you are financially free for life, this is the definition of this 4% rule. You are financially free for life once 4% annual withdrawal in your investments can cover your annual expenditure. So the formula application is straightforward. To calculate your financial freedom number, okay, you multiply your annual expenditure by 25. So, for example, you want to get your expenses of 10,000 Rand a month, multiply that by 12 to get your annual expenditure, which is 120, multiply that by 25. You need 3 million Rand capital saved up to give you that monthly income. Okay, you'll see these numbers come up quite often just now. So that's just a number to start off with. Yes, it is a rule of thumb number, and I want to highlight again for you a very quick rule of thumb. People don't know there's something to aim for. Okay, so it's a ballpark figure. It's a quick and dirty, I call it the quick and dirty financial freedom number. Let's be clear, there are plenty of alternative formulas used by financial advisors and financial planners, such as, you know, achieve a net worth equal to 20 times your average gross income. That's one way of looking at it. Achieve a net at least 8 times your ending salary, your last salary before you retire. Okay, so 8 times that. There's ways, but just understand this 4% formula. It's just a golden rule, as I say, quick and dirty. If you truly want to articulate your calculation and customize the underlying assumptions, okay, you must rely on online calculators, and there's quite a few of them out there. After all, you must give some thought to the following questions. 4 questions that is important to understand. Okay, what are the expected returns on your investments? Is it 3%, 6%, 10%? Remember that rule of 72. Okay, at what age do you want to retire? Some people want to retire at the age of 55. They find out they don't have enough. They have to extend it, which is always maybe better. Okay. What is your current net worth? So your total assets minus all your debt, your liabilities, that'll give you your net worth. Okay. What's the inflation rate you're working with? So yes, government tells us we're around about 7.5 or 6.5, 7.5%. You might want to go a bit higher. So those things that you want to take in consideration. So just that rule of 72. Remember, when you get this presentation, maybe, as I said, I'll be sending the recording as well as a PDF of this presentation. Okay, let's go to the next slide. Let me take this out the way quickly. So, what are the best investment vehicles? Okay, and this is quite interesting. There's no single investment vehicle or strategy that guarantees financial freedom. Yeah. So, yeah, there are some popular and potentially lucrative investment options, and they include obviously things like unit trusts and exchange traded funds and shares. In this context, obviously, because we have PSG Wealth, we online stockbrokers and wealth managers. So we're mainly involved in the share market, but also remember there's things like rental properties and a lot of other side things we can talk about. Okay, so in this context today, I want to highlight for you unit trusts. They offer an affordable and a very diversified approach to investing. What I like about investments also about unit trusts, they have the building blocks. So you know you can start as little as 500 Rand a month, monthly contributions, taking advantage of rand cost averaging. You know, you're going to slowly build up capital. You're going to slowly have that investment growth coming through. Any dividends or income interest is reinvested, help you with the growth. As in when you have extra income, you add it to it. So the whole idea, as I say, is a building block towards wealth creation. So a lot of people have that in place. And remember, we have a whole range available on the PSG Wealth platform. We have over 450 funds. You want to maybe have exposure to equities, you want to have exposure to property, money market, you name it. Everything's there for your investment goals, your risk appetite, you name it. Okay. But also saying that within the unit trusts, on our platform, we have a lot of what do we call wrappers or tax efficient vehicles. And this is what I want to highlight for you. You know, things like the tax-free investment plan. You know, you have the end result where all your growth and your capital gains and all that is tax-free. Okay. So yes, there are limitations in the sense of contributions, 36,000 a year, 3,000 a month. Or lifetime limit of 500,000. But it's a nice way to complement your retirement fund. And that's the next one I want to highlight is your retirement annuity. And I have harped on this before in previous webinars. So say it's your contributions are tax deductible. You know, you might have a pension or provident fund of your existing company. You want to maybe add more to it, have a retirement annuity. If you're a company owner or a sales consultant, you need to have this in place. Remember, it's tax deductible. And then obviously another vehicle you could look at. Another thing about what I like about a retirement annuity, you can nominate beneficiaries. Okay, your creditors can't get a hold of your retirement savings. Those are the things that are in your favor too. Endowments, for those of you that have income, your tax rate is way above 30%. Endowments is another vehicle to look at. So again, you could also use beneficiaries there, add beneficiaries. Then I want to talk about the exchange traded funds. They, you know, very similar to unit trusts, but the big difference is here they are traded daily on the stock market. You can create a separate portfolio of just ETFs. So it's as I say, it's low maintenance. You don't have to do anything about it. You're tracking the market. One way of looking at it. And then I'll spend some time on shares. This is where this whole presentation is going today. Investing in shares can generate high returns, but it comes with significant risk. But I want to highlight for you a strategy, and we talk about a dividend portfolio. How do you create a dividend portfolio, something that I can live off? So there's 5 steps you can look at. You know, determine your income needs, build a diversified dividend portfolio, calculate your expected dividend income, monitor your portfolio, and consider the impact of inflation on your portfolio. So yeah, I'm going to go into a bit more detail with this. But the main idea here is when your household wallet is getting the squeeze, having additional source of income to supplement your retirement income is a real win. So this is just another, call it another arrow in your quiver, okay, having various means of creating passive income. So I saw this thing where millionaires have at least seven income streams, different income, passive income streams. So this is just one of them. Okay. So you can look at it as this can be a hobby that gets you a bit of cash, or extra room in your house that creates also some income for you, a second property that you rent out. These are all different ways of creating passive income. But what I want to highlight for you now is just something that provides a monthly income in the form of dividends. So yeah, we're going to explore the theoretical possibility of constructing a portfolio like that using the local market. So the idea is living off a dividend portfolio can be a great way to generate income or in retirement to supplement your income. Obviously, you want to focus on dividend-paying companies. But this, as I say, the other 5 steps I'm going to go into more detail now. So number 1, as I say, determine your income needs. The whole idea here is to set yourself up to live off your dividend portfolio. But you need to start understanding what you need. So, you know, your again, your monthly expenses at 10,000 Rand, multiplied by 12. We spoke just now about it, 4%. So this is where you're looking at dividend yield now. So you want to build up, how much money do I need? Remember I mentioned previously that rule of, if you're looking at 4%, your portfolio or capital, starting capital portfolio of 3 million Rand. Okay. So let's say, for example, you can also look at this way, if I'm looking at 240 and my existing portfolio is giving me 7.5%, so I take 240 divided by that 7.5% that you're getting my existing portfolio, okay, I need roughly about 3.2 million Rand. So it's very much in the same ballpark. Okay, so again, when you get this presentation, look at a scenario. So this gives you, it tells you your ballpark figure, what you need for a starting capital. So let's say, for example, I want to build a diversified portfolio. And when I say diversified portfolio, you want to spread it between 3 and 5 different sectors. Okay, you don't want to put all your money in gold shares, for example. So you want to spread it between 3 and 5 different sectors. So financial, some in mining, and some in resources, and some obviously industrial stocks. But also across between 8 and 12 different shares. So we talk about the structure of the portfolio, so the quality. Is it large cap stocks or the mid cap stocks or the small caps? We're talking about blue chips, green chips, and red chips. Okay, but also you can look at the spread, and that's where diversification comes in. That's how we manage risk in a long-term portfolio. So the idea is to, and this is what I suggest you guys do, that you have a share trading account of us, create use your watch list on Viewpoint and build a watch list of potential winners. Have some top 40 stocks, mid caps, and small cap stocks in that portfolio. And then obviously look at the dividend yield. The higher the dividend yield, the better, but there's no guarantee that that's sustainable. So yes, you want to look at quality and obviously sustainable dividend payers. Okay. So here's an example. What I did here in this example, I just went onto Viewpoint. I looked at the top 40 index and I ranked them by the dividend yield. So I came up with 12 shares. So in my example here, let's say for example, I'll go 1.2 million that I want to invest. I want to build a dividend portfolio. I want to put 100,000 Rand into each share. So here's my little portfolio that came up. So you can see, let me bring up my little cursor here again quickly. So this is the PE ratio of all these stocks right now. You can see they're very low, very, very cheap. These shares are cheap. The average of these top 12 shares, the PE ratio is the price to earnings ratio is 6.79. So it can take you 6 years to recover the current earnings of the current share prices. Okay, compared to high-tech stocks where over 30, it can take you for more than 30 years to recover the current earnings. So these shares are cheap. Okay, I'm not, remember my disclaimer here, these are not shares to rush out and buy. I'm using this as an exercise to highlight the dividend paying portfolio as such. So this is the gross, that's what that G stands for, gross dividend yield on the portfolios right now. So this is all yesterday's data. So Exaro has a dividend yield of 14.41, growth point 10.67. Then what you do then, you subtract the dividend withholding tax, because remember we got a 20% dividend withholding tax. So that times 20%, and that gives me a net dividend yield of 11.53. That's what I did, all these stocks here. So the gross dividend yield is 8.64 on average. My average net dividend yield on these shares here is 6.92. Okay, so as I say, what it is my gross times 20%, and that's how I work on the dividend. So I want to work with after tax, after dividend withholding tax numbers. So this is yesterday's closing share price on Exaro was 192. So remember in our example, we only got a dividend yield. So remember, a dividend yield of the shares, the dividend per share divided by the price per share. That's how you get a dividend yield. Okay, so the dividend yield, okay, divided by the price, that's how we get a dividend, the dividend yield. That's how it's calculated. So if you want the dividend per share, okay, you need to multiply the dividend yield by the share price. So that by that, and then we get our dividends per share. So that's what that stands for, dividends per share. So in this scenario right now, Exaro should be paying 22.15 Rand per share in dividends. So in my example now, going back to, as I said, we had 100,000 Rand, that divided by the current share price. Just to simplify, there was no brokerage or anything like that. I would have bought myself 520 shares. Now, to calculate my dividend payment, how much am I expected to get? So that times that, to calculate the expected dividend income, I multiply the current dividend yield, that, okay, multiplied by that, okay, multiplied by that gives me my dividend yield, okay, my dividend payment expected. So you can see my whole slide here. All these different yields. Remember, the companies pay out, most of them do pay out twice a year, what they call interims and then finals. So you can expect dividends twice a year. The ideal situation, that's why I use 12 shares also. Imagine having a scenario where you have 12 companies, each one paying dividend income every month, January, February, March. Okay, that's the ideal situation, but you won't get that very easily because remember, some companies have different financial year ends. Some might be in February, tax year end, some might be in June, some might be in September, some December. So these dividends will be lumpy, or might be also be quarterly. Okay, so the idea here, as I say, if our goal was to get 120,000 Rand, you can see number one, that's our big problem there, we are short. So what else can you see is wrong with this presentation, with this portfolio? Hopefully you can see that this is not a diversified portfolio, because there's out of the 12 shares, 5 of them are in mining and resources. In other words, 42% of my portfolio is in mining and resources. What else is wrong with this presentation, with this portfolio? So yes, I got 2 shares in property. I got Growth Point and I got Nepi Rockcastle. I got 3 banks. I got Nedbank, Absa, and Standard Bank, and then also I've got a financial stock or insurance company in Old Mutual. So if I look at it broadly, I've got 42% of my portfolio in mining and resources, and then another 50% in financials. And only one stock, 8%, is in industrial stock, my British American Tobacco there. So that's a problem with this portfolio. So remember, for the exercise, for the exercise of this, for this exercise, I just used the top 100, top 40 stocks and divided by 12. Okay. So I fall short on my dividend income goal of 120,000 Rand. So 120,000 Rand, less my 83,000. I'm still short roughly about 36,000 Rand. But the whole idea is a starting point. You know, so the starting point gives you the idea. So, you know, I have to look at my options. You know, I might have to lower my expectations on dividend income. Might have to increase my capital. Instead of putting 1.2 in, I might have to increase it by another 800,000 to get it to 2 million Rand to maybe achieve my goal. That's one way of looking at it. Another way is also maybe looking at better or higher dividend yielding stocks. Remember, I'm only looking at the top 40 in this example. I haven't not looked at the high dividend paying stocks in the mid caps. That's the next 60 companies after the mid caps. I haven't looked at any high dividend paying companies in the small caps. Okay, so another way of looking at it. But also remember, this is one strategy, dividend income stocks. I might look at rental property, I might looking at side hustles, etc. But I hope you guys got the idea here. By the way, I did the same exercise with exchange traded funds, and I was also short there. And to be interesting, when I did it with ETFs, it was obviously all the government bonds. So obviously they're paying interest. Just remember, the interest is taxable. That's income tax, not dividends. So again, I got to about 75 or 78,000, still short on that. But yeah, interesting little exercise. So I hope you guys found this useful. So the idea here is when you're looking at a portfolio, obviously the main thing here is to go for stable stocks. You want stability of dividend payers. Ideally, you should be avoiding commodity stocks like all our top 5 companies there. You know, I like to have some exposure still. I still like Sasol a lot. Yeah, 42% of our portfolio is in resources, and you know, they might look good now, but they might disappear when the cycle turns, commodity cycle turns. That's something you must be very much aware of. But also, you want to keep the lesson that we learned from the COVID pandemic, that the most stable dividend can also vanish very fast in a heartbeat. Okay, so the idea here is to choose wisely, select companies that are quality and are sustainable dividend payers. Don't just look at the recent payments and things like that. So yeah, you need to monitor. Step 4, you need to monitor your portfolio regularly. Make sure they're still paying, they're performing well and paying consistent dividends. It's important. But also, if your dividend yield is 4% and inflation is at 6%, just understand that this is not enough. Down the line, things are going to get more expensive, and inflation is going to eat up a lot of that. So make sure that your investment income outperforms inflation. Okay. So I hope this has made some sense to you guys. It's just one little strategy I came across. Let me just put my cursor back. Sorry. I'm getting feedback here that the slides are not moving. Is that true? Slides are not moving? I don't know. Sounds good. What else is there? What other questions you guys got here quickly? Yes. So slides are not moving. Oh no, don't tell me that. Showing page 16. Ah, they're moving now. Okay. Oh dear. We'll have to look at the recording. So guys, in my summary, before we handle any questions, financial freedom, as I said, begins with the end in mind. You want to set financial freedom as a clear written goal. Calculate that financial freedom number, that rule of the rule of 4. Your annual expenditure times 25 will be your financial freedom number. The whole idea is just to have enough in place so you have that freedom of choice. You want to create a diversified portfolio. In our context today, obviously unit trust, ETFs and shares, but obviously you can also look at rental income from property and things like that. But the main idea, you want to have various income streams and multiple income streams. Okay. So as we say every month, this presentation will be sent out hopefully by Friday. Hopefully the recording's fine. But go click on these different links and go learn about the products. So yes, as I understand what are the best investment products, look at those tax efficient vehicles. I spoke about the tax-free, the retirement annuity, the endowment. And then those of you that have the risk, have the time and things like that, maybe look at having a share portfolio. Okay, so let me see what other questions you guys have got. I'm very upset about this presentation not moving. So Vessel, good question there. Is inflation included in these calculations? Maybe the 4% drawdown. I'll work on, as I say, that net dividend yield. That'll be my drawdown. So I'll look at net. Inflation. So I'm talking about tax here. I don't know. No, I haven't taken those in consideration. But yeah, that's a very important question to take into consideration. So yeah, I haven't gone into that too much there. Okay. Cool. Guys, let me see what other questions are. The other question you have from Jan says, can I create a portfolio of ETFs for dividend income? As I said, I did a similar exercise. Government bonds, etc. They're high interest. They're not dividends. Obviously, that's income tax. So also understand, with ETFs and things like that, not all they don't distribute all the income to you in the form of dividends into your account. They reinvest it. So you want to find those ETFs that do pay out a dividend income. So yes, obviously focus on those ETFs that are more equities than interest. Here's a question from Susan. Can I use derivatives such as single stocks and CFDs to trade to make passive income. Yeah, you can do that if you have that risk appetite, Susan. Yeah, remember the main thing there about derivatives, that they are leverage products. So yes, they're more capital efficient. Also, that's number one. And number two, I think the main big attraction there is obviously lower cost compared to shares, especially if you want to be more actively trading. So yes, they are more shorter term. You know, it takes time. There are a lot of rules in place. I believe in having a trading plan. You know, if you have 100,000 Rand and you work in, and the main focus here always is managing risk. You know, the goal, I believe, always with trading is being consistently profitable. You know, if you're taking 100,000 Rand, you take 2% per trade, 2,000 Rand, and that's what you're going to risk to lose. In other words, you have what they call position sizing, and you're using stop loss. Yeah, there's a lot of possibilities. So it just takes time. You know, if your goal is to get 2% growth after all costs every month, you know, 100,000 Rand, 10%, that's extra income. It's only 2.5% after costs per week. You have to do on trades, so you might have to do a few trades to get your 2.5% average. If your goal is to get 20% or 20,000 after costs, you know, you're talking about 5% growth per week after costs. So all those things are possible, but again, as I say, it's consistently, and main thing there is managing risk. But guys, from my side, I hope you've learned something, found it beneficial. Until next month, any questions you guys have, you're welcome to drop me an email at wealth@psg.co.za. Give me a call on the live stream or one stream, 0860-000-368. But from my side, thank you very much for being on this webinar. As I say, all these slides I had with the different shares, remember, just for education purposes only. I'm not soliciting any investments from that, but as I say, for education purposes only. But from my side, thank you very much for being on this webinar. Until next month, all the best. Bye for now.